spotlight on the primary market, red hot, right? IKS Solutions, 2,500 crore IPO opens today for subscription. It's an offer for sale, 1.87 crore shares. To discuss this in some detail, we have Sachin Gupta, whole-time director and chief executive officer of the company, and Nithya Balasubramanian, Chief Financial Officer at IKS. Thank you very much, Sachin and Nithya, for joining us here in the studios.
Thank you for having us.
Sachin, we're speaking to you for the first time. Nithya is a known entity for us because she was the pharma analyst at Bernstein, so quite a switch.
Thank
Nithya, and
you.
I hope
Fabulous to be back chatting with you and your viewers.
In your new avatar, and great to see you. It's a company with no real listed peers and we'll get to growth projections and all of that in just a bit. But just very briefly, Sachin, if you can explain, what does the company really do? And because you work in the US, what does it do in what area? If you can give a brief snapshot.
Sure. So look, I think the whole genesis of the idea is based on the scale and inefficiency in US healthcare. If you think about it, India is about a $3.3 trillion economy growing at about 6.5% real terms. US healthcare is a $4.8 trillion industry growing at 6.5–7% on a secular basis. And I think, the US, we call US the temple of capitalism, and capitalism stands on these two pillars of efficiency, technology and globalization. And yet the largest industry in the US, which is healthcare, seems to have under-leveraged these two pillars of efficiency, technology and globalization. And our whole idea was to bring these two pillars of efficiency to the US healthcare provider segment. The payer and the pharma segments had already leveraged these pillars, but the provider segment had not. And within that 4.8...
hospitals?
Actually, no. Within that $4.8 trillion, we deliberately decided to focus on a segment called the physician group segment, which is the physician clinics, as they call it here in India. Now, that market segment alone is $1.5 trillion.
In terms of spends?
In terms of their revenue that is reimbursed through physician clinics. And we realized that that segment was going to become the new fulcrum of healthcare delivery. Traditionally, hospitals used to be the fulcrum of healthcare delivery. We now realize the physician groups would become the fulcrum because remember, 90% of healthcare dollars in the US outside of end-of-life care are spent on chronic lifestyle disease management. You try to manage chronic lifestyle disease, diabetes, COPD, congestive heart failure from the hospital.
What's the difference between physician groups and hospitals?
So if you think about it, that's the outpatient clinic, where the freestanding clinic where the physician takes care of the patient. And our whole idea is physicians need to proactively take care of patients with chronic lifestyle diseases so that they prevent them from disease states that take them to the hospital, which will then lower the cost of care and perhaps improve the quality of care. Hence, that physician space, that physician clinic becomes the most important point in healthcare. And that $1.5 trillion industry, we predicted as that becomes the new fulcrum, will start consolidating rapidly. A lot of private equity money coming in, also a lot of the hospitals and health systems buying the clinics. As that consolidation would manifest, finally, what was a cottage entrepreneurial industry would start to mature and they would start to look for areas of efficiency. And we built a very simple model.
So what do you do for them?
So we built a very simple model that essentially identifies what is the chore tasks that these physician practices should not be focused on. The reality, the statistic is nurses are spending more than 50% of their time on non-patient care, non-discretionary tasks. We built a technology-enabled platform that takes away all of these chore tasks so that they can focus on their core of patient care, which frees up more time. That means it improves the number of patients they can see, that improves access to care. They're also
so
able
what
to
are
take
these
proactive
tasks?
care.
And so you provide software?
So we basically use a combination of technology. Our first instinct was just write technology to eliminate these tasks. Some of these tasks are clinical in nature, like clinical documentation, medical coding, prescription refills. And then some of these tasks are purely administrative in nature related to billing and collections. Our first instinct was just write technology to eliminate these tasks. But because we are pragmatic, we also realize that technology often needs human in the loop to truly eliminate the task. That's where our India strength came in, where we could deploy India-based global human capital to supplement the technology, to supervise the technology. We have 7 or 8 Gen AI cases going on there. So, those often have biases, the Gen AI hallucinations. So the human supervision comes from our India-based workforce. And through a combination of the humans and tech, we're able to eliminate those tasks for these people. They're spending 15% of their revenue on these tasks. Prashant, that's $225 billion. Put that in perspective, the entire Indian IT services outsourcing industry today is $250 billion. So we had found a TAM nearly the size of the entire Indian IT services outsourcing industry, growing at 7%.
I just have one question. So what you're describing sounds fantastic. I mean, it's a sitting duck opportunity, perhaps. I don't know how others didn't see it. But looking at the financials, and we'll just put them up for our viewers as well, revenues have grown in a very nice way from 760 crores in FY22, now to northwards of 1800 crores as of FY24. Now, I'm just trying to understand a business like this, what margins does it operate on? Because you were at 38, 39%, now it's about 31%. But isn't this a low entry barrier business as well? Can't a lot of the other, tech biggies, including the Indian tech companies, can't they come in and simply disrupt and drive margins lower?
So actually, to the contrary, entry barriers have become very high. So, if you think about it, what did we do over the 18 years? We actually built proprietary technology in very close collaboration with these healthcare enterprises because the workflows are very nuanced. It's not a standardized industry. So we actually co-developed this technology across these 16 tasks, which we call features of our platform. And that co-developed technology sort of has become our moat. And because it's a tech-led human-in-the-loop offering, the margins are at that 38, 39%. The reason they dropped to 31% last year was because we acquired a company called Acuity Solutions, which has a very large customer base. IKS traditionally had about 35,000 physicians under management. There are 900,000 physicians in America. IKS had 35,000 physicians under management. We acquired Acuity last year that actually has 120,000 physicians under management. So together that's 155,000 physicians, which is 18% of all of America's physicians. That becomes now our captive customer base into which we can cross-sell our entire platform, which forms the growth thesis for the next 10, 15 years. As we cross-sell our platform across these 155,000 physicians, it creates a captive opportunity of up to $28 to $29 billion. Today, we are about $315 million in revenue. So that creates that massive growth opportunity.
So it was because of this acquisition that, last year there was a dip, but then what's a steady state? I mean, is 30, 37, 38% steady state margin for your business?
No, we're suggesting, we're seeing margins in the range of early to mid 30s as we stabilize. So if you see our first half fiscal 25 numbers that just got updated in the RHP, we're back up to 28% margins from the pro forma 24% that we had dropped to last year. So that 28% starts to reflect that climb back to the early to mid 30s, which is where we hope to stabilize. And that's because we continue to intend to increase our spend in R&D. We spent about 5.5% on R&D as a percentage of revenue. We expect that to go up to 7.5%, 8% because we're building so much Gen AI and making investment in technology. And that's why we're saying we'll stabilize in the early to mid 30s.
Okay, all right. Hi, welcome to the studio and thanks a lot for joining in. I've learned a lot from Nithya over the years and good to have you, Sachin, as well. You're telling us about a new subject, something that we don't talk about very, very often. But let's get a couple of questions out of the way. Sure. This entire, offer is an OFS. So most of the money goes, to the person that's selling. It doesn't come to the company. How is the balance sheet looking as of now? How do you fund growth? Point number one. Point number two, earlier you all were looking at selling, I think, 2.8 crore shares, which has now come down, I think, to around 1.8 crore. Why so? Yeah,
so first of all, the business has always generated healthy cash. With those EBITDA margins, our EBITDA to operating cash flow conversions have always been 100%. So up until last year, we had about $100 million of net cash on the balance sheet, no debt, after paying $50 million in dividends. And we acquired Acuity for about $220 million in cash, because of which we had $100 million cash, so we took on $120 million of net debt. But the business continues to generate healthy cash.
So much of cash, you'll be debt-free in the short term.
Next year. So there's no need for primary capital.
So that's out of the way.
And the OFS is simply because, the way our cap table is between the two promoter families, Mr. Jhunjhunwala's family and me, we own about 70% pre-IPO. Yeah. 25% odd is owned by employees and ex-employees. And about 5% is owned by some H&I board member types that came in early. 18 years later, our employees that have put in their blood, sweat and tears had seen no liquidity. So I felt like it was time to offer that. And that's why we're doing this 16% OFS. 10% of the 16% is being sold by employees and 6% is being sold 3% each between the two families.
But why was it scaled down from 2.8 to 1.8?
Actually, that was just because we did a pre-IPO. We had so much demand for the IPO that because we wanted to make sure we are allocating appropriately to the best investors, we did a small pre-IPO round.
Okay.
Nithya, come in here. So in the US, and this is a slightly high-level question. We can go micro once again, but you've got a new administration coming on, and you've tracked that very closely, especially healthcare. I mean, it's completely, you would agree, the system is messed up for consumers, end consumers, and you've got the new health secretary who's promising to really shake things up, and no one really knows what to expect. Do you expect an upheaval, and does it in any way? We don't know what's going to happen, and there are second order, third order effects. Do you think things will change the way sort of healthcare is delivered? Could it be as big? We'll find out soon enough. But what are your thoughts?
It's obviously very difficult to predict what this administration might or might not do. But I think if you just step back and think about it, most administrations, recent administrations in the US, the intent has been to reduce the total cost of care and improve the quality of care. And if you look at the provider organizations, the way they're going to achieve it is by trying to extract more and more efficiencies from these provider organizations. And we as a platform are actually part of that solution, right? We're actually able to bring so much efficiency into these providers. So hopefully we believe that whichever way the wind blows, we are actually part of the solution and not the problem. So we are hoping that regulations will remain a tailwind for us. Even if you look at it historically, the kind of regulations that have come through tend to have increased administrative burden for these provider organizations. And that usually presents as an opportunity to actually add to a platform. We're able to come up with new features and add on to a platform. So again, we'll have to take it as it comes, but we're hoping it'll be possible.
Just one more thing, and it's just coming to mind, so let me ask this question. Another recent listing, Sagility, operates in this space. Now, they're not your competitors just yet, because I think they work with US hospitals and provide tech solutions for the US healthcare industry. But could they become competition? I mean, just asking a question that would be on people's mind. That stock's been doing very well after listing, by the way.
So actually, Sagility focuses on more on the payer space, the health insurer space. Okay. They're really not so focused on the provider space. We're purely focused on the providers, and within that $1.5 trillion segment of the physician clinic space. So not really competitors. Also, ours is a more platform-led strategy, which is fundamentally different. You know, we're a platform as a service business. But yes, we have seen how Sagility has performed lately, and it's good for everyone, I guess.
Sachin, what kind of growth should we expect over the next, I mean, I know you can't be very specific, but broadly give us a sense. I mean, 24 over 23, we saw very large growth. What is the steady state revenue growth we should expect?
And if you could also tell us about your geographic breakup. You know, as of now, it's mostly the United States. Is there an opportunity to de-risk yourself only from the United States market? I know you're saying it's a big opportunity, but any plans?
Yeah. So look, I think the tasks that we are focused on, these guys are spending $225 billion a year on. That market is growing at 7%. Of that, only $30 billion is outsourced so far. The outsourced TAM is growing at 12%. If you look at our historical growth rates from FY22 to 24, it's, you know, on a standalone basis, we're 27%. So when you look at the outsourced TAM growing at 12%, our historic growth rates, our acquisition of Acuity and the massive customer base in which we can cross-sell, we feel very confident that we will far outpace the outsourced TAM growth rate of 12%. Beyond that, you know, time will tell.
Far outpace 12% could be anything. I mean, give us a broad, a range. What should we expect?
Look, I would be happy to give you a range if I could. You know, this acquisition is still a little new. If you just extrapolate our historical growth rates and the fact that now we have an even bigger captive install base to sell into, hopefully that should give you some sense.
And a lot of your work is outsourced to India. It's being done out of India. Just try to understand.
Yeah, so of our 13,000 people, 10,000 are across 7 cities in India.
In India.
And where we apply actually 1,700 physicians in addition to the technologists that are writing the technology.
So it's like a KPO GCC model here in India? Like people sitting here and kind of doing the work.
Yeah, but we remember they are supervising and supplementing the tech that we have built. And that tech does core of the task.
Sure.
And that tech is supplemented by the humans.
No, we were just asking because, you know, come January 20, we will hear and, you know the new US president's mind on things like outsourcing. So just you know, putting out all the potential sort of issues on the table. Thank you very much for joining in.
Thanks very much. Good luck.
And good luck.
Thank you for
Thank you for having
the
us.
issue. Thank you. Okay, let's quickly move on. Lots of stocks moving around. One of them is Newland Laboratories. Vivek was telling us about potential large